Hey guys, welcome back to the channel. In this video, I'll be giving the July update on my dividend-focused portfolio in M1 Finance. I'll be going through my full portfolio that has a current value of just above $4,180, and I'll be talking about why I made some of the changes that I did in the last month. I'll also go through each dividend payment that I received to show how, although insignificant in amount, these payments will grow over time. Lastly, I'll be going over my thoughts on the congressional hearings that took place over the last week, and specifically how that impacts my thoughts on Facebook and the outlook on their business moving forward. So make sure you stick around to the end of the video to hear that. Before I get started, I just want to ask for your help on something. If you get some enjoyment or value out of these videos, please consider subscribing and turning notifications on. Right now, only 13% of the people who watch the videos are subscribed, and of that group, only 13% have notifications turned on. So if we could slightly improve those numbers to even 20% each, it would drastically help the channel. So please consider doing that, and thank you to everybody who supports this channel. July was another successful month for the portfolio. Not only did we have $220 in market gains, but we also received 7 individual dividend payments totaling $10.64. The opinions of other people can significantly sway stock prices, but in general, a good, stable company will continue to pay its dividend and increase it despite changing opinions, and that's the focus of this portfolio. To begin the month, on the 7th, both of the bond funds made dividend payments of 38 cents and 25 cents. On the 15th, I received dividend payments from 2 different REITs, WP Carey and Realty Income Corp, of 36 cents and 37 cents. On the 24th, I received dividends of $4.46 and $1.43 from Simon Property Group and Toll Brothers. And then, just on Friday, I received another $3.36 dividend payment from JPMorgan Chase. All those payments add up to $10.64 in the month of July, which sets the record for dividends received in a month in this portfolio. On screen now, you can see a graph of my dividends since I started this portfolio back in February. Just as a disclaimer, the reason this graph looks so impressive is because of the deposits that I make into this account. Every week, I deposit $150 into this account that gets auto-invested based on the allocations that I have set for my portfolio. So not only do I get the benefit of the companies increasing their dividend payments, but I also get more shares of all the companies, which is the main driver in this growth, because it's a fairly small portfolio right now, so the deposits have a large impact compared to it. As time goes on, the hope is that the passive income generated from these investments continues to go up. However, I do recognize that this is the fastest I will ever see the dividends grow. And as time goes on, this growth will probably slow to below 10% a year, although we are probably at least a decade away from that point. Now, let's jump into the portfolio allocations that I have set for each industry. To start off, I wanted to address the absence of one slice that I've had in my previous episode, and that is my bond position. I made the decision to sell out of my bonds for a couple reasons. First, I'm not really at a point in my life where the additional diversification brought by bonds is necessary. For some context, I'm 22 years old, and that means that I'm a very long way away from retirement age, a point where the safety of bonds and the fairly consistent payout provided is much more valuable than it is at someone in my position. Also, bonds are considered less risky than equities or stocks because historically they've been less volatile, which means they're at a lower risk of losing a substantial portion of their value. However, I believe that there's an even larger risk to the future value of this portfolio that bonds create. Right now, with interest rates at historically low levels, bonds do not have substantial yields. I believe before I sold out of my positions, their yields was more or less about 3%. And with the United States Fed pumping money into our economy at crazy rates right now, the risk of higher inflation rates increases as well. Powell has said multiple times that it would not be a bad thing if inflation rates were higher than 2%, because for the last couple of years, we've had lower inflation. So if I continue to hold bonds in my portfolio, I could lose some of the purchasing power of that money, because bonds are not operating companies. They're essentially just the payments that come to investors. There's no additional upside to holding bonds that comes with holding equities in companies, so I'm taking on the risk of purchasing power dilution without getting an additional upside. So it doesn't make sense to me right now to hold bonds in this portfolio. I guess I really didn't think very hard about it when I created this portfolio, because I thought it was just something that income-seeking investors did. So I didn't question it. But over the last month or so, I gave it a good hard look and a lot of thought, and this is the decision I came up with. But I'd love to hear your opinions in the comments below. On screen now, you've been able to see the allocations that I have set for my portfolio. Real estate is still my highest industry at 25%, and this has not changed over the last month. But there was a change inside of that slice. Last month, I had 4 companies in my real estate pie, and I decided to sell off one of my earliest investments, Simon Property Group. I already went ahead and made a full video on my rationale behind my decision last week, but I did get a lot of confused comments in that video, so I wanted to make a clarification to my thesis, and I'll give some context to those who have not watched the video yet. Essentially, I saw a lot of events happening around the company that are very ominous, and I believe they're indicative of future long-term struggles for the company. For example, I discussed how Simon Property Group canceled their acquisition of Taubman Group, and how they were opening up massive lawsuits against their tenants that have not paid their rent during this whole pandemic situation. The way I described it in the video made it sound like I was selling solely for those reasons, which can definitely seem short-sighted. And since I claim to be a long-term investor, that justifyingly confused some people. To clarify my point, I believe that the issues that I laid out in that video, along with more, are signs that the company will have to struggle for years, and unless the management continues to make all the right decisions, which, although it's possible, is probably unlikely, Simon Property Group will not be as competitive or as good of an investment in 5 to 10 years from now. I decided to sell because the other companies that I hold in my real estate pie are super solid, and I have more faith in Toll Brothers, Realty Income Group, and WP Carey's long-term success than Simon Property Group right now. So I funneled the money from the sale into those other holdings, mainly into Realty Income Corp. Next up, we have my financials pie, which increased in size to 18% of my portfolio due to the bond sales. Now, the composition of this pie has not changed at all since the last update. However, I'm looking into 2 different companies pretty closely right now, and I'm pretty sure at least one of them will make a good addition to this group in the near future, so stay tuned for that. 14% of my portfolio is technology, which is much higher than my last update, thanks to a couple different influences. First, as previously mentioned, I sold my bond holdings and needed to allocate that money into other industries. But second, I agreed with the thesis laid out in a recent video by Joseph Carlson. Now, it's not too hard to imagine, but I respect the investing prowess of Joseph Carlson, and our channels do have a lot of similarities, which I'm sure is partly because of the respect that I have for him and his success. Historically, investors have seen the tech industry as a riskier bet than other industries like healthcare, financials, and utilities. However, our economy has evolved super quickly over the last 10 years, and the points laid out by Joseph in the video linked in the description convinced me that tech is not as risky as some of the traditionally defensive sectors. Further, when I look at the companies in my tech portfolio, only AT&T does not have an immaculate balance sheet, while Facebook and Microsoft balance sheets are almost perfect with huge piles of cash available and almost no debt. So that's why I felt more comfortable increasing the allocation of tech in my portfolio. For the remaining sectors, not a lot has changed in the past month. Healthcare currently sits at 14%, with industrials at 12, consumer at 11, and energy and utilities at 6. I think this goes to show that when a portfolio is set up well and you have good companies that you invest in, you really don't have to make a ton of decisions. As long as your original decisions were good, you only need to make another decision when things fundamentally change for the company or your investing strategy, neither of which is the case for these industries. Also, I know I brushed over those really quickly. However, an updated link to my portfolio will be available in the description below, so you guys can go in and check out all of my holdings and my portfolio as a whole. So hopefully it helps you guys to see my full portfolio as it stands and how it slowly evolves over time. The last thing that I want to touch on in this video is the congressional hearing that took place over the last week that was focused on if the tech giants, namely Amazon, Facebook, Google, and Apple, are monopolies and if they need to be broken up. Now, I think these conversations are necessary, and there were a few points brought up during the hearings that were important and do seem like anti-competitive behavior. But as a whole, the hearing was basically a waste of time. I'll play one question that sums up how pointless these hearings can be.
Mr. Bezos, are stolen goods sold on Amazon?
Congresswoman, not to my knowledge, although there more than 1 million sellers, and so I'm sure that there have been stolen goods
Really, Mr.
sold
Bezos?
on Amazon.
Really, Mr. Bezos?
I'm sorry.
There's not? You don't believe that there is? That
said,
surprises me.
No, I just said with over 1 million sellers, I'm sure that it has happened. But certainly, I don't think it's a large part of what we're selling.
Okay, so Mr. Bezos, basically then you're saying yes.
I guess so.
Okay, so I want to ask you about information that you require from sellers to prevent the sale of stolen goods. Do you require a real name and address, yes or no?
For sellers?
Once again, do you require a real name and address from sellers?
I believe we do. But let me get back to your office with I'd rather give you the accurate answer, but I think we do.
Right. And I'm aware that you are. So, yes, you do require a name and address. Do you require a phone number, yes or no?
I don't know if it's required. I think we often have it, but I don't know.
So briefly then, how do you verify that each of these pieces of information is accurate?
I don't know the answer to your question.
So you don't know how many people work on verifying seller verification before the seller is allowed to sell on Amazon?
No, Congresswoman, I don't.
Okay, then I'm going to ask you, sir, will you commit to reporting all sales of stolen and counterfeit goods to law enforcement, and to victims to track large-scale offenders engaged in organized retail crime?
To the degree that we're aware of it, we will certainly pursue it. In fact, I would.
Sir, can you just make a blanket commitment? Can you just make a blanket commitment, whether you're aware of it or not?
A blanket commitment to what? Sorry, Congresswoman, I'm trying to be helpful.
Reporting all sales of stolen and counterfeit goods to law enforcement and to victims to track large-scale offenders engaged in organized retail crime.
I see no reason why, if we're aware of stolen goods, we wouldn't report it. We would want the correct law enforcement authorities to be involved.
Okay, thank you so much.
Now, I don't know if you guys caught that or not, but this Congresswoman wants Amazon and Jeff Bezos to commit to reporting things that they don't even know about, which, to be clear, is a stupid and impossible commitment to give, and it's not something you should request. But specific to Facebook in these hearings, I don't think there were really any hard-hitting questions asked in respect to any competitive behavior. In a second, you can hear a part of Zuckerberg's opening statement that I think is a very sound argument against the antitrust claims against Facebook.
Many of our competitors have hundreds of millions or billions of users. Some are upstarts, but others are gatekeepers with the power to decide if we can even release our apps in their app stores to compete with them. In many areas, we're behind our competitors. The most popular messaging service in the US is iMessage. The fastest growing app is TikTok. The most popular app for video is YouTube. The fastest growing ads platform is Amazon. The largest ads platform is Google. And for every dollar spent on advertising in the US, less than 10 cents is spent with us. We're here to talk about online platforms, but I think the true nature of competition is much broader. When Google bought YouTube, they could compete against the dominant player in video, which is the cable industry. When Amazon bought Whole Foods, they could compete against Kroger's and Walmart. When Facebook bought WhatsApp, we could compete against telcos who used to charge 10 cents a text message, but not anymore. Now people can watch video, get groceries delivered, and send private messages for free. That's competition. New companies are created all the time, all over the world. And history shows that if we don't keep innovating, someone will replace every company here today. And that change can often happen faster than you expect. Of the 10 most valuable companies a decade ago, only 3 still make that list today. And if you look at where the top technology companies come from, a decade ago, the vast majority were American. Today, almost half are Chinese.
So overall, I'm not concerned about these hearings as a Facebook investor, and I'm still comfortable in owning the company, and I'm excited about their future. And with that, guys, if you liked the video, please subscribe, like, and turn on notifications so you're notified whenever I release a new video. And I will see you guys in a week with another video.